Picture this. It's the summer of 1929. Jazz music fills the air. Flappers dance in speakeasies. The stock market has been climbing for nearly a decade. Everyone from Wall Street bankers to shoeshine boyses getting rich off stocks. The newspapers trumpet the arrival of a new era of permanent prosperity. Economic experts declare that the old boom-on-bust cycle has been conquered forever. Sound familiar? What if I told you there was a specific warning sign in 1929 that almost nobody talks about today's signal so clear, so unmistakable, that a handful of investors saw the crash coming months in advance? And what if that exact same warning is flashing red right now in 2026? This isn't about market timing. It's not about predicting the next correction. This is about understanding a fundamental shift in market psychology that precedes every major financial catastrophe and recognizing that we're reliving through that shift right now. The forgotten warning of 1929. When we think about the 1929 crash, we focus on the obvious signs: overvalued stocks, excessive margin debt, the sudden panic selling in October. But there was something else happening in the months before Black Tuesdays, something more subtle, more insidious, and far more predictive than simple overvaluation. In early 1929, a peculiar phenomenon began occurring in the financial markets. Professional investors, the old money, the experienced bankers, the institutional players who had survived previous panics began quietly exiting their positions. Not all at once, not with fanfare or dramatic pronouncements. They simply stopped buying with the same enthusiasm they once had. Meanwhile, something unprecedented was happening on the other side of the market. Retail investors, regular Americans with little to no investment experience, were flooding into stocks at record levels. Housewives were trading on margin. Farmers were mortgaging their land to buy shares. Bellhops were giving stock tips. The market wasn't being driven by fundamentals anymore. It was being driven by pure speculation from people who had never experienced a bear market. This divergence, this transfer of ownership from experienced hands to inexperienced ones, was the real warning sign. The smart money was getting out, the dumb money was pouring in. And when the music finally stopped, it was the newcomers who were left holding the bag. One investor who recognized this pattern was Roger Babson, an economist who gave his famous Babson break speech on September 5, 1929, warning that sooner or later, a crash is coming, and it may be terrific. The market briefly dipped, then rallied even higher. People mocked Babson. They called him a pessimist, a fearmonger, someone who didn't understand the new era. 7 weeks later, the market crashed, the pattern that repeats. Here's what most people don't understand about financial bubbles. They don't pop because markets become overvalued. Markets can stay overvalued for years. Bubbles pop when there's a fundamental shift in who owns the assets. Every major market crash in history has been preceded by this same transfer of ownership. The experienced sellers exit, inexperienced buyers enter. And the last wave of optimism, the final surge before the collapse, is always fueled by people who have never witnessed a real bear market. In the late 1920s, it was housewives and farmers. In 1999, it was day traders quitting their jobs to trade tech stocks from home. In 2007, it was people with no income buying multiple investment properties with subprime mortgages. The faces change, the assets change, but the pattern remains eerily consistent. Why does this matter? Because this transfer of ownership doesn't just signal overvaluation, it signals the complete absence of a safety net. When experienced investors hold most of the assets, they know when to cut losses. They understand risk management. They've been through crashes before and survived. They provide stability to the market. But when inexperienced investors dominate the market, there's no one left to buy the dip. There's no institutional support. There's just panic selling all the way down with nobody to catch the falling knife because everyone got in at the top. The 2026 echo now. Let's talk about today. Let's talk about what's happening right now in 2026 that should make every investor's blood run cold. Over the past several years, we've witnessed an unprecedented democratization of investing. On the surface, this sounds wonderful. More people have access to financial markets than ever before. Trading apps have made it effortless to buy stocks, options, and cryptocurrencies with just a few taps on a smartphone. Financial education content has exploded across social media platforms. But dig deeper and you'll see the same pattern that preceded 1929. According to recent data, the percentage of stocks owned by retail investors has surged to levels not seen since the late 1960s, another period that preceded a devastating bear market. Meanwhile, institutional ownership as a percentage of total market capitalization has been declining. Smart money is reducing exposure. Retail money is increasing it. Look at the options market. Retail investors now account for approximately 25% of equity options activity, compared to just 10% a decade ago. These aren't hedging strategies. These aren't sophisticated spreads. These are speculative bets lottery tickets, essentially placed by people who learned about options from YouTube videos and Reddit threads. Consider the rise of meme stocks and cryptocurrency speculation. Millions of people who had never invested before suddenly became traders during the pandemic years. They experienced a market that only went up. They learned that buying dips always worked. They developed an unshakable faith that markets would continue rising forever. This is the cohort that now dominates retail trading. They've never experienced a prolonged bear market. They've never watched their portfolio lose 50% of its value. They've never felt the psychological devastation of a true crash. And they're convinced it can't happen to them because they're smarter, more informed, more connected than previous generations. This is exactly the psychology that prevailed in 1929. The 7 warning signs. Let me outline 7 specific parallels between 1929 and 2026 that should concern every investor. First, the new era narrative. In 1929, people believed technology had created a permanent new era of prosperity. Radio, automobiles, electrification, and aviation were transforming society. Productivity was soaring. Economic experts declared that the old rules no longer applied. Today, we hear identical rhetoric about artificial intelligence, automation, quantum computing, and biotechnology. We're told we're in a new paradigm where traditional valuation metrics don't matter. Companies losing billions are valued at hundreds of billions because they're disrupting industries. The parallels are uncanny. Second, margin debt explosion. In the 1920s, investors could buy stocks with just 10% down, borrowing the rest. Margin debt exploded, creating enormous leverage in the system. When stocks fell, margin calls forced mass liquidation, accelerating the crash. Today, margin debt has reached record levels multiple times in recent years. But it's not just traditional margin anymore, it's options leverage, cryptocurrency leverage, and complex derivatives that most retail investors don't fully understand. The leverage in the system today may actually exceed 1929 levels when you account for modern financial instruments. Third, unprecedented retail participation. As mentioned earlier, retail investors now represent a larger share of market activity than at almost any point in history. What's more concerning is the demographics. Surveys show that a huge percentage of young investors believe they can consistently beat the market, and many are using money they can't afford to lose. Fourth, dismissal of traditional metrics. In 1929, people stopped caring about price-to-earnings ratios, dividend yields, or balance sheet fundamentals. All that mattered was momentum buying, because prices were rising, not because companies were fundamentally sound. Flash forward to today. How many discussions about popular stocks mention actual earnings, cash flow, or profitability? Instead, we talk about community, disruption, narratives, and diamond hands. Fundamentals are dismissed as outdated thinking from people who don't get it. Fifth, everyone has a system. In the 1920s, countless surefire systems emerged for beating the market. Technical analysis was born. Chart patterns were worshipped. People genuinely believed they had discovered secret formulas for guaranteed profits. Today, every social media platform is flooded with trading gurus, signal services, and algorithmic strategies that promise to unlock easy wealth. The democratization of financial information has created an illusion that anyone can become an expert overnight. The confidence in these systems is absolute until it isn't. Sixth, credit expansion and asset inflation. The 1920s saw massive credit expansion, with easy money fueling both stock speculation and real estate bubbles. When credit contracted, asset prices collapsed. We've just lived through more than a decade of historically low interest rates and unprecedented monetary expansion. Although rates have risen recently, the amount of debt in the system, government debt, corporate debt, household debt, is at all-time highs. Asset prices across stocks, real estate, art, collectibles, and cryptocurrencies have inflated to extremes. The question isn't whether a contraction will happen. Seventh, the "it's different this time" mantra. This is perhaps the most dangerous parallel. In 1929, people genuinely believed the boom-bust cycle had been conquered. Modern economics, they thought, had made crashes obsolete. The Federal Reserve, still relatively new, was seen as a safeguard against panic. Today, we hear the same refrain. Central banks have more tools than ever. They can print unlimited money. They can intervene in markets. They won't let a crash happen. Modern financial engineering has distributed risk so effectively that a 1929-style crash is impossible. These are the exact rationalizations that precede every major crash in history. Why the smart money is quietly exiting. Here is what the financial media is untelling you. Institutional investors are reducing risk exposure in ways that don't make headlines. Major hedge funds have been quietly lowering their equity exposure. Warren Buffett's Berkshire Hathaway has been holding record amounts of cash, even as markets reach new highs. Corporate insiders, the CEOs and executives who know their companies best, have been selling their own stock at elevated rates. This doesn't mean these investors expect an imminent crash. It means they recognize that risk-reward ratios have become unfavorable. When stocks are expensive and downside risk is high, smart money reduces exposure. They're not trying to time the market perfectly, they're playing defense. Meanwhile, retail investors are doing the opposite. Survey after survey shows overwhelming bullishness among individual investors. Cash levels in retail accounts are at historic lows. Everyone is fully invested. Many are leveraged because they can't bear the thought of missing out on further gains. This divergence is the warning sign. This is 1929 repeating itself. The psychology of market tops. Understanding why these patterns repeat requires understanding human psychology. Market tops aren't characterized by fear, they're characterized by euphoria. Everyone is making money. Everyone feels smart. Skeptics are ridiculed. Caution is seen as cowardice. This creates a self-reinforcing cycle.
Yes.
Prices rise, more people jump in, pushing prices higher, attracting even more people. Traditional measures of value stop mattering because momentum itself becomes the justification for higher prices. It's going up because it's going up becomes perfectly logical reasoning. But here's the cruel irony. The better this works, the worse the eventual outcome. The longer the euphoria lasts, the more leverage accumulates in the system. The more people who get involved, the more money is at risk. The higher prices go, the harder they fall. At market tops, virtually everyone who wants to buy has already bought. There are no new buyers left. And when the first wave of sellers emerges, whether due to technical triggers, margin calls, or simply profit-taking, there's nobody left to buy. The bid disappears. Prices gap down, panic spreads. This is what happened in 1929. It's what happened in 2000. It's what happened in 2008. And it's what will happen again. What's different this time and why it might be worse. Now, I need to acknowledge that 2026 isn't perfectly identical to 1929. Now. Important differences, and understanding them, is crucial. Modern markets have circuit breakers that halt trading during extreme volatility. The Federal Reserve has far more tools and experience managing financial crises. Deposit insurance protects bank accounts. Regulatory frameworks are more robust. Social safety nets exist that didn't in 1929. These safeguards might prevent the absolute economic catastrophe that followed the 1929 crash. They might limit the downside. They might create faster recoveries. But they might also create a false sense of security that encourages even more risk-taking. And in some ways, the current environment is actually more precarious than 1929. The interconnectedness of global financial markets means contagion spreads faster than ever. High-frequency trading and algorithmic systems can amplify volatility in microseconds. Derivatives markets have created layers of complexity that even experts struggle to fully understand. The concentration of assets in passive index funds means that selling pressure, once it starts, could be more intense than previous crashes. Perhaps most concerning, the political and social environment is more fragile than at any time since the 1920s. Economic crisis doesn't occur in a vacuum. It has political consequences. And those consequences, in our current moment, could be severe. The contrarian's dilemma here is the frustrating reality. Being right too early is the same as being wrong. Roger Babson warned about the crash in September 1929. But people who sold after his speech missed out on several more weeks of gains before the crash. Some probably bought back in at higher prices. The market mocked him before it proved him right. If you move to cash today, based on these warning signs, markets could continue rising for months or even years. You'd miss those gains, you'd feel foolish. You'd watch others get rich while you sat on the sidelines. The psychological toll would be enormous. This is the contrarian's dilemma. Seeing a problem before others do means enduring ridicule during the delay between recognition and realization. It means watching the bubble inflate further while everyone calls you paranoid. But here is what I've learned from studying financial history. Being early is still better than being late. Missing the final gains of a bubble is far less painful than riding the crash down. Cash doesn't lose 50% of its value. Pride recovers faster than capital. What you should actually do, I'm not here to tell you to sell everything and hide in a bunker. I'm not predicting the exact date of a crash. Nobody can do that, and anyone who claims they can is lying. What I'm saying is that the warning signs are clear. The patterns are repeating, and prudent investors should be taking defensive measures. Here's what that actually looks like in practice. Reduce leverage. If you're trading on margin, using options for speculation, or carrying debt to invest, now is the time to scale back. Leverage amplifies gains in bull markets and destroys capital in bear markets. Don't be the person who gets margin called at the bottom. Increase cash positions. This doesn't mean going 100% to cash. It means having enough dry powder that you can survive a downturn and take advantage of opportunities when they arise. Cash is optionality. In a crash, it becomes the most valuable asset, but focus on quality. If you remain invested and there are good reasons to prioritize companies with strong balance sheets, actual profitability, reasonable valuations, and competitive moats. These companies survive downturns. Speculative growth stocks with no earnings and massive debt don't. Diversify beyond financial assets. Real assets, real estate, without excessive leverage, commodities. Productive businesses have intrinsic value beyond market sentiment. Paper assets can go to zero. Real assets generally can't. Prepare psychologically. This might be the most important step. Understand that your portfolio could lose 30%, 40%, or 50% of its value. Visualize how that would feel. Decide in advance what you would do. Don't let emotion drive decisions when panic hits. The historical perspective. Here is some perspective that might help. Every major crash in history has eventually been followed by recovery. Markets have always reached new highs. Eventually. The S&P 500 today is far higher than it was before 1929, before 2000, before 2008. But eventually is doing a lot of work in that statement. It took 25 years for the Dow Jones to recover its 1929 peak. It took 15 years to recover from the 2000 tech bubble. The Japanese stock market still hasn't recovered its 1989 high. That's 37 years and counting. The problem isn't whether markets eventually recover. The problem is whether you can personally survive the crash and recovery period. If you're young with decades until retirement, you can probably ride it out. If you're near retirement, if you're heavily leveraged, if you need that money in the near term, you might not get the chance to wait for recovery. This is why these warnings matter. Not because crashes are permanent, but because they're devastating to people who aren't prepared. The final warning, let me close with a story. In the spring of 1929, Joseph Kennedy, patriarch of the Kennedy family and a savvy investor, was getting his shoes shined when the shoeshine boy started giving him stock tips. Kennedy went back to his office and immediately sold his entire portfolio. Why? Because when the shoeshine boy is playing the market, there's nobody left to buy. The bubble has reached its maximum extent. Everyone who can possibly get in has gotten in. Today I see teenagers on social media discussing option strategies. I see people with no financial education confidently declaring that certain investments can't lose. I see the same euphoria, the same certainty, the same dismissal of risk that preceded every major crash in history. The warning of 1929 wasn't complicated. It wasn't hidden in obscure economic indicators. It was visible in plain sight. The wrong people were buying while the right people were selling. Experience was exiting while inexperience was entering. The foundation that supported the market was crumbling even as prices reached new highs. That same warning is flashing today in 2026. You can choose to heed it or ignore it. You can adjust your risk or maintain maximum exposure. You can prepare or hope for the best. But you can't say you weren't warned. History doesn't repeat exactly, but it rhymes. And right now, the rhyme scheme is becoming uncomfortably familiar. The question isn't whether you believe a crash is coming. The question is whether you're prepared if it does. Because just like in 1929, the crash won't announce itself in advance. It won't be a clear signal that says sell now. It will happen suddenly, violently, and without mercy for those caught unprepared. And when it's over, the same excuse will be repeated that has been used after every crash in history. Nobody could have seen it coming. Except that's never true. Someone always sees it coming. So the warning signs are always there for those willing to look. The only question is, are you looking? So what do you think? Are we heading toward a 1929 style crash, or is this time really different? Drop your thoughts in the comments below. I read every single one, and I'm genuinely curious where you stand on this. If you found this analysis valuable, smash that like button and subscribe to the channel so you don't miss future warnings like this. We're diving deep into the economic patterns that matter, not just recycling the same surface level takes you'll find everywhere else. And speaking of warnings, if you're concerned about what we just discussed, you need to watch the video appearing on your screen right now. It's the 7-stage dollar decline, because if the market crashes, it won't just affect stock prices. It'll fundamentally reshape the dollar itself. Click it now to understand what's coming next. Thanks for watching, stay sharp, and I'll see you in the next one.